And so the moment I've been warning about for 3 to 4 weeks could nearly be here, could be moments away. Bitcoin could be heading back to the lows of 17,600. Yes, Bitcoin has fallen back below 20,000, and the markets are now focused on two key catalysts, which are 24 hours away or less. And I need to bring you guys up to speed on what this could mean for Bitcoin and the crypto price. Guys, smash up the likes. Don't forget to subscribe. As always, if you want to trade any of these moves, BYBIT and BitGet, links in the description. Get yourself set up. Take advantage of those bonuses which they've been kind enough to offer this community. And let's get trading. Now, as you can see, guys, we've been in this downward channel for quite a while. And what is the key pattern been which I've shown you? I've shown you that we see a consolidation, we fall. We consolidate, we fall harshly. We consolidate, we fall harshly, and we consolidate. And as you can see, we're starting our fall to the downside. Now, what did I say? From when we fell here, back in here, where we create our lows of 17,600, 19th, 18th June, I said, even despite the rally to the upside, people were getting excited, right? It went up as far as 2021, 22,000. People saying, oh, look, we're going to recover, and they were FOMOing in. I said, no, we're going to revisit that 17,600. Be patient, because the trend is with the bears. I mean, if we bring out the EMA ribbon, you can see the bears are in full control of this trend. Do not fall for any of these consolidation pumps, right? Because even in this situation here, did you see that? Once we consolidated, you had that little run up. Everybody thought, oh, look, we're back, we're good. And then it throws it back into the pattern. Same here. It was running, looked like we were good, froze it back into the pattern. And that's what we need to be wary of. And now you can see there's the perfect concoction of fear in the market, which I'm going to walk you through right now. And the first thing is, let's take a look at the wider markets and let's look at the pre-market. And what you'll see is yesterday the markets were red, and today the pre-market are showing red as well. You're seeing 0.6 down on the futures, 0.5 on the S&P futures, and the Nasdaq down 0.36. Okay, now what are markets wary of? Two things are in focus. The first is the CPI reading for tomorrow. Yes, CPI reading is coming out tomorrow. Remember, CPI is sitting at 8.6% according to their reading. We know in real life it's probably much more than that, but according to their reading, it's 8.6%. Expectations are that could be as high as 8.8%. But here's the catch. Here's what the press secretary from the White House just said.
So on Wednesday, we will have new CPI inflation data, and we expect the headline number, which includes gas and food, to be highly elevated.
So as you can see, when they're telegraphing it that badly, it's clear that it's going to be a bad one. They're expecting this to top estimations, and 11 out of the last 12 estimations on CPI have surprise to the upside, which is a bad thing. Okay, so we're expecting inflation to come in hot, and if this comes in with a 9 handle, if it's 9.0, 9.1, 9.2, this market can react badly to the downside. If it comes in at 8.6 or less, we can continue to see maybe a little bit of a sideways, maybe a bit of a rally. But anything above 8.6 and definitely above 9 is not going to be great for the market to the downside, okay? So inflation continues to be out of control. Now, if we take a look at this, you can see the S&P is now sitting with record shorts here down at 10% of people short in the markets. This is asset managers, hedge funds, institutions. They know we're heading for a lower low here now. We're going to go create a new low, and that's what everybody is now expecting in the market. Now, I wanted to share a little bit of hope here because we can't get caught. And this is always the rationale of this channel is we will look at what the data is suggesting, but we have to be smart. We have to keep our brain switched on. So as you can see, everybody's expecting the market to fall. That's fine. But I also think that we should be careful because inflation can move very quickly. Take a look at this chart here. This circled area here shows how high inflation got back in the 70s and then in the 80s when it ran up to 14.8%. But what I want you to focus on is look how quickly it came back down to 2.5%. And this is the same thing. If I move myself out the way here, you go up there, mate, you can see inflation is really skyrocketing now to 8.6% here. But when you see these steep climbs, often that shows that inflation can fall back just as quick, okay? So once these issues do resolve themselves, don't think that inflation is just going to be like 8.6, 8.5, 8.4, 8.3 month by month, just coming down slowly. It can drop down once the Fed figure it out, once they get quantitative tightening going, once any of the supply side challenges have resolved itself, and once things are starting to take effect. Really can plummet in a couple of meetings. You don't want to get caught on the wrong side of that investment thesis as well. So I need to warn you guys, yes, it's bad right now. Yes, we're expecting lower prices down towards 17,600 in my personal opinion, but things can start to get better with inflation quite quickly. And that's what brings us on to the second thing, because markets kind of understand where they're at with inflation. They're almost at peace with it. Yes, they'll react to the reading when it comes out, but it's not on their mind day and night. It's not giving them sleepless nights. What's giving them sleepless nights right now are the earnings forecast. And we're now in earnings season, okay? So we're going to get PepsiCo in a couple of hours. You'll get Delta tomorrow. You've got some of the important banks later this week. And the markets will be looking at those earnings with a keen eye. And what they're looking at in particularly is not just what revenue and earnings are they showing, but what are their future projections? In the earnings calls, are they talking about rising price pressures? How are they affecting them? How are the rising prices affecting their business? Are there any signs of slowing demand? And more importantly, with the Fed slowing the capital supply, is that having an effect on their day-to-day business as well? So this is the main focus right now. And if these companies start to surprise to the downside, we will continue to see red days like we saw yesterday. Yesterday was just a taste of that. We had a red day in the markets yesterday. Bitcoin fell as well because Wynn Resorts, Las Vegas Sands, they produced negative earnings over in China, affected by the COVID situation over in China, and they were down 6% each yesterday. So the market will be reacting strongly to not just earnings, but the projection of future earnings that are mentioned in the earnings calls. That is very, very important. Right, let's get back into a few other things I did want to show you. So we've covered that off. Now, Celsius also have managed to reclaim $172 million of collateral from Aave and Compound. That's good. So remember, they're trying to pay off these loans on the DeFi platforms to claim their collateral back. They've still got a bunch of work left to do here, but I guess at least they're trying to execute on a plan. So I'll continue to update you on anything if we hear from here. And also, the other thing I wanted to share with you was this. This is the consumer sentiment. Now, this is important to look at. So what you're looking at is the CPI is the red line and consumer sentiment is the blue line. This is measured by the Michigan Consumer Sentiment Report, which comes out on Friday as the next reading. This is very important. The Fed looks to this because the consumer sentiment is a lead measure for what could happen in the economy, because what consumers expect, they then price into their actions, and therefore that becomes a self-fulfilling prophecy in the market, okay? And as you can see, as CPI climbs, sentiment tanks. These are inversely correlated. So you can see here, sentiment fell to record lows when the inflation came to 8.6%. And again, if this tops 9, sentiment's going to continue to fall, and that's going to affect and slow demand in the economy, creating that slowdown. Remember, we're going to get our Q2 GDP figure later this month. We also have the FOMC meeting later this month. So a lot of catalysts to fear the market right now. Okay, so with that said, what are we looking at? We can see we're in this channel. We created this pattern. Could we then see a fall down to at least here? For me, I think at least 17,600. But if things come in pretty nasty with the economy, there's no reason you can't work your way to the bottom of this channel, and things start to then look a bit different at 13,000, 14,000, 15,000 price targets as you work your way. Because as you can see here, every time it's fallen after the FOMC and CPI readings, they're big sharp falls. If we get that big sharp fall here, then what will that look like in terms of price targets? Now, the other way to look at this is to look at the symmetrical triangle pattern, because obviously we broke out from this symmetrical triangle pattern, which then became the channel which I shared with you. But what you could argue is if we now fall back into this triangle, which we've literally just done, and fall to the downside, then you're playing out the bearish scenario from this symmetrical triangle, which again gives you that same price target of about 14,000, which also has confluence with this horizontal support line as well. So a lot of levels are telling us 14,000 could be the level we could be falling down to here. And for me, I'm quite happy with this. I think this will be a great opportunity to buy the dip. I mean, also, if you look at this channel here, if you get a breakdown from this same channel, this shows you easily we can get to the bottom of the wedge at 17,000, and if not, start working our way down towards the other support levels towards 14,000 here. So, for me, this is a great opportunity to buy the dip. This is something I was waiting for since we bounced from 17,600. You guys remember I shared a whole bunch of on-chain metrics. I shared a bunch of technical analysis as well to suggest I don't think this is quite it. It didn't feel right. The drawdown wasn't as deep as previous bear markets. The percentage of wallets in profit was still higher than previous bear markets. Retail investors were still quite encouraged to buy the dip. There still was a little bit of tourism in the industry where people were still buying. It just didn't feel like we had full capitulation. So I'm expecting the economy to continue to deteriorate before it gets better, and that could drive us to the downside a little bit more. So definitely I will be looking to more downside to the downside. Yes, that's difficult psychologically, but as long as you have conviction, As long as you continue to buy the dip, that's the key here. I mean, for me, if I can pick up any Bitcoin closer to that 17,600 line, I will be nibbling. If we fall below 17,600, I'll be taking bigger and bigger chunks, because those price points, you don't know how long they're going to last for. The closer we get to 15, the bigger the bites I'll be taking in terms of my dollar cost averaging. Hope you guys enjoyed this video. As always, don't forget to smash up the like button and subscribe. If you appreciate this type of content, let me know in the comments. Do check out BYBIT and BitGet, links in description. Get yourself set up on there. Collect your bonuses, guys. Thousands of dollars in bonuses to collect from those two platforms. So get yourself set up, trade on there. Go watch this video, and I'll see you on the next one.